This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thank you for joining us. My name is Bruce Norris, and today our special guest is Kris German. Christopher is Vice President of Investments in the LA and San Bernardino counties. He specialized in selling multi-family residential property since joining RE/MAX Commercial in 2007. Kris is constantly ranks among the top 3 commercial agents within the RE/MAX Commercial National Division, and over the last 12 years has been awarded every award RE/MAX has to offer: the RE/MAX Hall of Fame Award, Chairman's Club Award, Lifetime Achievement Award, and most notably the prestigious Diamond Club Award in years 2015, 16, and 17. Christopher, we welcome you to our show.
Thank you for having me.
Obviously, we're not usually attached to apartments, but because you've allowed me to speak at your event, and we do have investors that have some investments in apartments, I just thought I'd like to get your take, and also the little of the history that you've seen since you joined the apartment. So 2007 was a pretty interesting year to get involved in apartments.
Yeah, I always joke. I got my license on Monday, and on Wednesday they decided the market should collapse. And so, I was new to real estate in 2007, and as we all know, the mortgage crisis took place. And although apartments didn't have a mortgage crisis, so to speak, apartment properties values began to tumble, and so from 2007 to about 2010, and it was about the bottom for multifamily. Sellers were chasing buyers in terms of pricing, and it was an interesting time. I mean, you look back then, if we're talking about, let's say, the San Gabriel Valley, property at 10 times gross, probably 6.5 cap at that time, and buyers were still standoffish, still complaining it wasn't good enough of a deal. And you compared to today, where things are 16 times growth in some of those same communities, and so prices have really escalated since then.
Well, it's an interesting journey that you've taken in just the 12-year period. When housing was booming in 2005 and 6, did that cause a lot of vacancies in apartments? I'm just curious. I know you came in 2007, but housing boom was still, on Monday, you still had to look at what had transpired. So did so many people get to own a house that apartments had suffered?
No. So when I was new in the business, first thing is they say, okay, go, depending upon your geographical area that you're going to work, pull comps from the previous 5 years so you can get to know the data. And it really didn't have an impact on vacancy. Rents were nowhere what they are today, but rents still had gained steam. And it didn't have the impact that one would have thought that, hey, if all these people are buying homes, that means they're vacating apartments. And I'm not saying that wasn't the case, say, in the A-plus areas, the Burbanks and the South Pasadenas of the world, because that's a different tenant base. But if we're talking more middle of the road, blue-collar areas, a lot of these individuals, even with the ninja loans and all these other loans that were in place, still had no choice but to be tenants. Okay.
Now, wasn't there some aggressive financing for apartment ownership during that same cycle, say 2004, 5, and 6? So did they have any problem with a glut of foreclosures in the apartment world at all?
No. So when I speak of apartments, we're speaking about strictly commercial 5+ unit properties. And if we take a look, again, going back to the San Gabriel Valley, and I always go back there because back in 2007, that was the only market that I worked in. It's grown since then. But literally 2 buildings that I remember, one in El Monte, which I sold for Cathay Bank, and there was another property in Whittier that actually Chase had foreclosed on, that another brokerage house sold, but I was representing a buyer at the time, are the only 2, honestly, that come to mind that were real foreclosures. There was other individuals that had fallen behind on payments, and there was notice of default, and we, us agents were chasing some of those and watching for them. But you did not have a big, calamity when it came to foreclosures in the multifamily world. Now, that being said, and now years later, having looked back at the data, obviously Riverside, San Bernardino County, especially San Bernardino, that is its own animal, and they did have their own issues, primarily because valuations fell so fast. And so, again, they had their own troubles. But going back to the San Gabriel Valley, or markets that were strong, say B, or even C plus to say A minus type areas, you didn't see the amount of foreclosures. And with respect to your question about creative financing, to the best of my knowledge, as creative as it got was interest-only loans. That there were options to have interest-only payments on commercial loans, and then which has come back now. It's not quite as common, but there are some interest-only options out there. But I would argue it's been more aggressive this time around. Interest rates were as low as 3.25%, say in 2016 or so.
Mm-hmm.
What happens to those individuals? And typically, for those who don't know, commercial loans are going to be fixed 3 years, 5 years, at most 7. If you try to fix a commercial loan for an apartment building longer than that, usually the money is going to cost you a higher interest rate and so forth. And most investors go with, say, a 3 or 5 year fix. Well, if you got a loan in 2016 and it was 3.25%, so that building you bought, even though prices were high, it still cash flowed well for you. What happens when it comes time to readjust? And now, let's say we're in 5.5, 6 range or something like this. That changes the cash flow substantially. So it'd be interesting to see what'll happen with those individuals, because they also got in many times as little as 25% down. So they may have more trouble, interestingly enough, than say an investor who bought last year at the top of the market, because in order for the property to debt service, the DCR ratio, many times buyers were putting 40, 45, 50% down. So they have a lot of equity in the building.
Right.
And, they're able to brace themselves for any fluctuations. I think better than those who not only got in with a very low down payment, not only did they get in at 3.25% rate, and then lastly, banks like Chase, it's stated income loans. You did not need to provide any financials, no taxes. Literally, you got to fill out just that, a stated cash flow sheet for yourself. And so long as your credit showed good, they got a loan. And those loans still exist today, the stated income loans.
So the apartment world sort of got more aggressive than the residential this time, except for big down payments.
Right. And the big down payment was only a function of the income relative to the price, because if you had a scenario where the DCR coverage that the bank was looking for could be met, they still would allow as little as 25% down right now on multifamily properties. And today's rate, there's one local bank. If the loan amount is more than $1 million, the rate's 4%. More average for the area, say about 4.5%.
Was there, since you joined in a very volatile year, did you come in and they told you things are going to change and they're going to get worse, or is this sort of something that blindsided the apartment world?
I would say it blindsided them, and thinking back, 12 years now, I guess, I just remember brokers commenting, the senior brokers in the office commenting that, gosh, properties are staying on the market longer. What's going on? We're having to put more muscle, so to speak, behind the listings to get them sold. And then I remember I had a property in escrow in the city of Almani, and and then the stock market fell. I think it was either a Tuesday or Wednesday, I forget. But I just know, literally, the stock market falls. I get a call the next day from the buyer saying, I'm canceling escrow. And it was a fairly good deal. And so when I questioned them why, they basically pointed to the stock market and said, we think that there's bad financial news coming, and so we're out. And, Why did the apartment market fall? Again, I'm not an economist, but a lot of it was psychology.
Yes.
People assume, if you remember at that time, people were talking about there's going to be bread lines and all kinds of things. And the psychology took the market. And interestingly enough, as American-based investors were exiting the market or they perceived too much risk in the market, here came the Chinese wave of money. It was the saving grace for multifamily because their expectations on rate of return was not as picky as an American-based investor. And they created, at least in the markets that I work, and even moving into San Bernardino County, they created the bottom. When they stepped in with their money, that created the bottom. Had it not been for them, my guess would be that our values would have continued to fall because the local investors were saying, hey, that deal needs to be 9 times gross, 8 times gross. And the foreign money came in and said, no, we'll accept 10 times gross, and now we'll push it to 10 and a half and 11. And probably in 2013, 14, going into 15, they had to have been, say, 60 to 70% of the buyer pool, like in the San Gabriel Valley.
Wow.
And they were the saving grace.
Did hedge funds play a role in buying apartments or not?
Not local here.
Okay.
Local here, if we're talking, my real wheelhouse is, say, 5 to 50 units. We have, done deals between 50 and 100, but say 5 to 50. And I would assume probably your listeners or your clients, most likely they own probably within that spectrum.
Yes.
It's mom and pop money and or say foreign investors who they themselves, let's say, are mom and pop, but not these big hedge funds. I imagine they're looking at the institutional type stuff.
What caused the Chinese to invest? And I'm asking the question because generally when I look at foreign investments and when they want it, it's usually at a peak of the market. In the past, they've notoriously been buying at the wrong part of the cycle. And this time that didn't happen. So what's your take as why that money was anxious to have a place to park and apartments just happened to be, ready to accept that money? But what was going on over there that allowed that transformation to happen at a good time this time, I guess?
So interestingly enough, the owner of our REMAX owns 6 or 7 offices, and he's Chinese. And a good portion of the agents actually are Chinese that work in our offices, say, that are like in Arcadia and so forth. And in 2015 or so, I joined with him. I was recruited to oversee the multifamily at his office. Previously, I was in downtown LA. But in quizzing him, it's because the Chinese, in the homeland, didn't know where to put the money or did not trust to put their money in Chinese investments. So they came here. Now, why specifically multifamily or what have you, I can't answer to that. At the same time they were investing in multifamily, they started building these mega mansions along the 210 corridor, primarily like in place in Arcadia, which now many of those still are sitting vacant today because that money has gone back to China. There's new rules. They can only bring in so much money now, and it's limited, and so they're not as much of a buying power. Going back to my equation earlier where during 14, 15, 16, let's say they were 60, 70%. Today, they're maybe 30 to 40%, and now the money shifted the other way where it's primarily American-based investors. But that's what I'm told. I can't say it as fact, but that they perceived keep their money in China as risky. Their investments over there are risky, so they brought it here because they feel that American real estate is very safe. Okay.
So from the bottom of the market, let's just talk about some of the numbers. How far have rents gone up in the inventory that you deal with percentage-wise from the bottom to now?
Gosh, in some areas, nearly double. My wife and I, we own apartments as well. And even just speaking personally with our own units. And in some of these communities that would have been assumed blighted, bread and butter, you have people being pushed out further and further, say, from downtown Los Angeles, and there are different areas, or gentrification taking place in different areas. And again, in some places, the rents have nearly doubled. And I would say probably your average, at least 50% in most areas.
And what about the cap rate journey from the bottom to now?
Probably at the bottom, the best you saw was around a 7 cap. And that might sound strange. I know maybe individuals who own or who are single family investors, they're maybe used to higher cap rates. I'm not sure, but a 7 cap was seen as a great deal. Today, we're at a 4 cap, and so that's a significant swing in value. And we seem to be hovering there, even as we move now into March. We still seem to be hovering in general, say between a 4 and a 4.5 cap. And so, bringing it home with regards to our discussion on mortgages. So now, what happens if interest rates, say, are 4.5, sometimes higher, and your cap rate is 4.5 or less? Effectively, you're losing money on the money borrowed. How much further do we have to go to push the buyers in terms of pricing? And I think that's something that the market's facing.
What's interesting is that twice a year I speak in front of the Apartment Owners Association, and about a year ago we had a crowd that was enormous. It was maybe an extra 75 to 100 people lining all of the walls, standing. And I thought, wow. I said, you guys are either really scared or really excited. And there was a little laughter, and somebody stood up and he said, we want to know if apartments are in bubble territory as far as their valuation. I said, I'm not an apartment guy, but I think I can ask one question and you'll tell me. I said, how many of you would buy your own apartment building at its current value? And Kris, there was like rolling laughter. And wow, I thought, that's the definition of a bubble. So are you concerned about the valuation that exists right now with the expectation? What is the owner's expectation? Are they expecting that value to hold or still go up?
I would say if we go back 2 years ago, you definitely had investors that were more optimistic in terms of this is going to be a great gravy train, and there was more that were optimistic as opposed to pessimistic. I would say now, generally speaking, it's about 50-50. When, we talk to a lot of apartment owners on a weekly basis, because it's not just myself, it's my team. And it's more of a split. Those that are saying, hey, I think time is on my side as a buyer, I'll wait. And again, prices are supply and demand. The more people that wait, it becomes a self-fulfilling prophecy for the values to fall. At the same time, I'm closing escrow on a building tomorrow in the city of Ontario. It's going to close at the highest price per unit that's ever sold for a multifamily building in the city of Ontario.
Okay.
So you still have that going on at the same time, but that's a rarity. More and more, you have buyers that are, say, skeptics.
What percentage of owners literally are permanent owners until the day they die?
Permanent, I'm not sure, so to speak. I mean, I guess just from, again, based upon the number of calls that we make, my team and I, the amount of clients that we meet on a day-to-day basis, those that are holding or in a hold pattern, they are 60%, 65%, and maybe the rest are open to an exchange or in the process of doing exchanges and doing things. Or or exiting the market altogether. Going back to this building in Ontario, the seller, this is it. They're cashing in their chips. They perceive the market is at its top. They don't want to wait for another cycle, another 8 or 10 years for things to come back around to where they are today. And so they've decided to sell. And it was a big decision for them because in this case, their family actually built the apartment building back in the 1970s.
And they had no 1031 exchange property to buy, so they just cashed it out.
Well, they're actually carrying back private financing.
Okay. Now, I was going to ask because, that's got to be a big tax advantage, correct?
Well, sure. If not, you figure, the taxes they would pay from their basis to what they're selling today would be huge. And that's usually my first question to an owner is, who are older and retired, if you don't need all the equity today and you don't know quite what to do with it and you're not excited about putting it in the bank at a 1 to 2% return and you don't want to give Uncle Sam 35, 40, 45% of your hard-earned equity, why not carry the note? And they chose to do so, and in this case, it's a 5-year term, and so they now have a monthly income for the next 5 years based upon the loan amount, and they deferred the majority of the capital gains until that balloon comes due.
They could also extend the note too, right?
Yeah, they could. At the end of 5 years, buyer and seller could come back together and see if they mutually like the partnership and want to continue on.
Yeah, that makes perfect sense, actually. How long do people generally own their properties? What's their intent going in? Do they expect it to be something that's short-term, or most of these are very long-term thinking buyers?
So I would say that most of them go into the scenario thinking, it's a stepping stone for me to continue to build. And now I'm sitting down with the investor who's, 40 years later, and he doesn't know why that stepping stone never grew. They still have the same, 5-unit property. And that's quite common. And it's the same thing where they'll say, Kris, if I was a younger man, I'd be up to do the exchange or what have you. But now I just, see it that I've passed my prime. And time just got away from them, either out of, maybe, life happens or complacency or what have you. And, that's why I tell them, especially if I can catch them early enough that, look, you have a 5-unit, you have a 6-unit. What's the difference between you and an individual that owns 50 units? It's just a matter of repositioning your equity and some information that you don't have right now. It's the only difference because I have clients who, again, own everything from, say, just a 5-unit to a gentleman I'm closing an escrow with tomorrow. He owns hundreds and hundreds of units. He started with 2 nickels in his pocket, didn't come from money, just utilized the market the last 30 years, continued to roll up. And he is the 300-pound gorilla in the room now with the amount of units he owns, truly. And so, and then I work with everyone in between. And that's why I say, having now quizzed these people, they're not geniuses. They didn't come from money. Their story is very similar to the person, probably like many of your clients, sitting on 1 single family or 2 or 5. And they just perceive that to make that leap, to move into units or to increase the number of units is more complicated and cumbersome than it really is.
Well, Kris, we are out of time, but I wanted to introduce you to our audience. So how can somebody get a hold of you?
Sure. So they can visit my website, theapartmentdealer.com, just like it sounds, theapartmentdealer.com. They can reach us on Facebook at The Apartment Dealer and or by email. If they have any questions for me, it's Kris with a K, Kris, at theapartmentdealer.com.
Okay. Kris, thanks a lot for your time today. I appreciate it.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.